London Eye. We have been discussing the markets with a whole host of experts. CNBC TV18's Udayan Mukherjee caught up with Archie Hart of Investec and began by asking him about the Brexit situation and how much of a problem it could be for emerging markets like India. Listen in.
I think it's going to be a very close vote. It's going to be a knife edge either way. I think what will happen will be there will be an instant reaction by the markets, but actually there will then be a very long period of negotiation between the EU and Britain if we were to vote leave. So actually I think after that knee-jerk response, things will settle down quite quickly to perhaps quite a prolonged period of uncertainty, but it's going to be a very interesting 2 or 3 weeks in the UK at least.
What's the market pricing in, according to you, right now?
I think the market is broadly probably a little bit on the complacent side, that it expects no change. So I think if we see a vote to remain, the markets will probably not do too much. If we see a vote to leave, there could be more of a sort of break in the markets potentially.
What do you see as a bigger trigger this summer? Is it what the US Fed eventually does, given the data it has on hand, or do you think it's something coming out from Britain?
I think Brexit really is very important if you're Britain or the EU. I'm not sure the effects globally are going to be hugely significant. I think the real thing will be the Fed, and actually probably the things that we can't forecast, the unknown unknowns that come from left field. And one of the more obvious places there might be, say, China, where I think clearly policy is evolving there, and that could be very influential on markets over time.
What kind of positioning do you see from most of your large investors? I mean, are they relaxed about emerging markets now after the pullback that we've seen since February, or are they still uncertain?
I think markets have been very bad for an emerging markets investor for several years. So the asset class has underperformed developed market equities now for several years. So investors in emerging market funds generally are feeling very beaten up. And although you've had that 20% rally from the very bottom, it only gets you back to where we would have been, say, a year ago. So I think actually a lot of investors are sort of making that decision between, is that rally the beginning of something better, or is this just a bit of noise in markets which will remain under pressure? And I think really that's interesting thing about our world is it at a turning point or not? We can certainly see signs of positive change in many respects. So the Modi government in India, Jokowi in Indonesia, recently a new government in Brazil. Companies are beginning to react to the new environment. So Brazilian banks have laid off 10% of the staff. They're becoming more efficient. Korean banks are cutting branches. Miners and oil companies are again cutting costs, generating more cash flow. But I think on a more wider basis, the trouble with our asset class is that it's very cheap. It's at a significant discount to its history. It's at a significant discount to the developed world. But our companies are still under very significant pressure. And that makes it difficult to make a sort of compellingly positive story at this point.
You can say with some confidence that earnings are beginning to bottom out in the emerging market universe in many countries, or it's too early to say that?
Unfortunately, it's too early to say, but at a turning point, the information's always unclear, we always have questions, etc. So I think what we are seeing is signs of a response by electorates, by politicians, by banks, by companies, by just the people of emerging markets. But I think it's too early to say whether that's going to feed into a positive earnings trend or not. I would say that I would be cautiously optimistic, but I think the word cautious is as important as the word optimistic almost.
Do you think things which are particular to emerging markets will drive this trend, or do you think it'll be still a global top-down kind of a trend, which will partly be determined by what the Fed does, what happens to the dollar, which will determine the outcome on emerging market equities finally?
I think the big defining issue of our age is the centrality of central bankers to our world at this point. So we saw in 2008 the central bankers step in and rescue the world from complete collapse. So we saw that huge liquidity injection, quantitative easing, all those ways of keeping interest rates very low, liquidity very high. Problem is, 8 years further on, I think we've reached that level of diminishing returns, and I think the markets are saying, if after 8 years you're continuing this policy of liquidity support for the markets, then something's badly wrong if we still need this 8 years into recovery. The central bankers appear to believe that what they need to do is more. If we do more, this will solve the problem. So, for example, the move from 0 interest rates to negative interest rates. The markets, I think, are not convinced. So I think really our world is going to be determined by the actions of those central bankers for better or for worse at this point. And I think that's quite a profound concern for many people that work in the markets, because I think we've had too much of a good thing and we need to move on, but that weaning ourselves off that liquidity is going to be a very difficult sort of transition point for the markets.
Okay, that sober thought.